Welcome back to Investing Talk Podcast.
Today we're looking at AST SpaceMobile.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For you, we've really been digging into the latest financials, all the operational updates, and just the general market sentiment around AST SpaceMobile.
And it is definitely a pure infrastructure play. It sits right at that cutting edge of global cellular.
It really does. It's one of those companies that, it just captures the imagination.
Because the idea is so simple.
Yeah.
Connect everywhere. But the engineering to pull that off is, well, it's anything but.
Exactly. So we really need to frame this as a high-growth infrastructure story. We're talking about direct-to-device satellite connectivity. This isn't just about launching another satellite.
No, it's about solving a very specific problem.
It's about solving the unmodified smartphone problem.
And that's the technological moat we keep hearing about, right? The key difference.
That's the one. The ability to provide actual cellular broadband from space that works with the phone already in your pocket.
So you don't need any special hardware.
No proprietary antenna, no satellite dish on your roof, nothing. And the reason they can do this, it's fascinating. It all comes down to their Bluebird satellites.
These massive satellites.
Immense. They use these huge phased array antennas. You should just think of them as enormous cell towers, but, in space.
Right, because a phone signal is tiny.
It's minuscule. And to pick that up from hundreds of miles away, you need a collection area that is just orders of magnitude larger than a normal satellite. That antenna architecture is their core IP.
And it's what rivals haven't been able to replicate yet.
Not at this scale. So if their tech works as promised, it just fundamentally disrupts how we think about coverage gaps.
Every phone on Earth could theoretically connect.
And that gives them a market size measured in billions of users, not just, niche enterprise clients.
And the market is starting to believe in that potential. Look at the partners they've signed.
Exactly. They have deals with major global telcos covering huge parts of the planet and, critically, contracts with the U.S. government.
That kind of partner alignment where the big cellular giants are betting on you, that says a lot.
It confirms their legitimacy, especially as they get closer to full commercial launch.
Which leads us perfectly into the financial story. And that might be the biggest news from the last quarter.
I think it is. The number one challenge for any big infrastructure build-out is always funding. Did they get the cash?
So did they?
They didn't just get enough cash. They completely transformed their balance sheet. The back half of 2025 was just this period of intense activity to lock down their financial future.
Okay, so let's unpack that liquidity story. It's a bit dense. There were a couple complex moves.
Right. Two main components, a massive convertible senior notes offering, and then also a successful run of their ATM.
All right, let's start with the notes. $1 billion.
$1 billion, yes, from the convertible senior notes offering in November 2025. Now, for listeners, these are basically debt instruments that can, under certain conditions, be converted into company shares later on.
It's a smart way to get cash now without huge interest payments.
Exactly. But it does introduce potential dilution risk down the road.
A trade-off any growth company would probably take.
Absolutely. Then, second, they used what's called an ATM, an at-the-market sales agreement. This just lets them sell shares directly into the market over time.
Which is much more efficient than a big traditional offering.
Far more efficient. It lets them top up the cash reserves when the stock price is looking good.
So when you add all that up, the convertible debt, the ATM sales, what's the bottom line?
The result is stunning. They finished Q3 2025 with over $2 billion in cash and equivalents.
Over $2 billion.
Yes, that's the highest cash level in the company's history, and it is the single most important factor here. It changes the entire near-term risk profile.
That gives them a runway that stretches well into 2026.
And likely into 2027. It covers all the expected spending to get from R&D to full commercial service. They've bridged the gap.
And that financial confidence, I assume, helps them win more commercial deals.
Immediately. And the biggest one we saw was that 10-year agreement with the Saudi telecom company, or STC.
The STC deal is huge. Why is it so important?
Well, it's strategic in two ways. First, it just confirms global demand. But second, and this is key for liquidity, the deal included a $175 million prepayment for future services.
Wait, they're getting paid upfront for services they haven't even fully launched yet?
Yes. It's a massive vote of confidence.
And pretty unusual in telecom.
Very. And that $175 million, it's not just revenue, it's non-dilutive capital. It goes directly to funding the rollout in that region.
So the partner's basically helping to fund the build-out.
It de-risks their entry into a foreign market. It's a brilliant model. It seems like their whole strategy is to avoid traditional bank debt.
It does. They're using customer prepayments, convertible debt, ATM sales.
Precisely. It keeps the balance sheet incredibly lean during this critical build phase. That $2 billion in cash can be used purely for capex and scaling, not just servicing interest payments.
Okay, let's talk about that scaling. The financials showed a pretty massive inflection point. A messy one, but big.
Things are definitely ramping up. We saw revenue surge from just $2 million in Q2 of 2025 to almost $15 million in Q3.
14.7 million to be exact.
Right, and that's at early commercial momentum, wholly from some initial hardware sales, contracts, testing fees with partners.
But investors have to zoom out. We also saw a net loss of what, over $120 million?
$122.9 million, yes. So for every dollar of revenue, they are spending many, many times that on development. The EPS misreflected that.
So how should we interpret that loss?
It's not necessarily a red flag. I mean, it's a symptom of an infrastructure company that's in heavy build mode. They're choosing to accelerate spending now because they see that 2026 commercial window opening.
They're prioritizing speed to market.
Exactly. And you can see that in management's guidance. They are signaling an absolutely sharp acceleration for Q4 2025.
What are they guiding for?
They're guiding revenue between $50 and $75 million.
50 to 75, wow.
It's a true hockey stick curve. I mean, to jump from under 15 million to potentially 75 million in one quarter, that requires flawless execution.
So hitting that guidance will be the big validation point in the next earnings call.
The single most important one.
And that kind of acceleration must require an incredible amount of capital spending right now. How much of that $2 billion are they burning?
It's a lot. Capital expenditures are budgeted to be between 275 and 325 million, just for Q4 2025 alone.
And that's mostly for what?
Predominantly for the production line and the launch costs for more Bluebird satellites, the core of the constellation.
So the whole bet right now is on rapid engineering execution. When do they actually flip the switch from heavy investment to recurring revenue?
The key inflection point is projected for early 2026. Management is forecasting they'll achieve early commercial activation then.
And what does early commercial activation actually mean?
It means intermittent nationwide service in the U.S. and a few other international markets. Once that happens, the revenue stream shifts from these one-off fees to high-margin recurring service revenue.
And that's when the flywheel really starts turning.
Exactly. And if you look way, way down the road, assuming they hit all their targets, the long-term outlook is what fuels this valuation.
How strong are we talking?
Some of the discounted cash flow models show that if they execute, annual free cash flow could exceed $4.3 billion by 2035.
$4.3 billion annually.
That staggering figure is the prize at the end. It's what supports the whole narrative for the patient long-term investor.
Okay, that gives you a sense of the scale. Now let's switch gears and talk about the market. How has the market reacted to all this news?
Well, the share price movement has been nothing short of spectacular.
It's been on a tear.
It really has. The stock has risen a massive 220% year-to-date as of November 2025. That kind of performance really puts it in that sustained bullish category.
Right, and it shows the market believes they've solved the funding issue and are now moving into execution mode.
For sure. But a 220% rise can sometimes mean a stock is overbought. What are the technicals showing?
That's the key question. Is this sustainable?
The indicators are actually pretty healthy. The stock is consistently trading above both its 50-day and 200-day moving averages. That's a textbook confirmation of a strong uptrend.
Okay, and what about momentum? What's the RSI look like?
The RSI, or the Relative Strength Index, it's sitting in a comfortable 55 to 65 zone.
So not in that overbought territory.
Not yet. If it was up at, say, 75 or 80, we'd be worried about a serious pullback. But 55 to 65 suggests there's still room for more upside, especially with more catalysts coming.
So what's a realistic trading range for the near term?
We're looking at a bullish range between about $65 and $95. And what's driving this isn't just retail enthusiasm, it's sophisticated capital.
The institutions.
Right. Institutional investors are increasing their stakes. They participated heavily in that recent convertible note offering, which signals a really strong positive positioning.
Speaking of the near term, what are the confirmed catalysts investors should have on their calendars for the next 3 months?
The next few months are pivotal. The most immediate one is the Q4 2025 earnings report that's expected in March 2026.
And that's where they have to hit that 50 to 75 million revenue guidance.
They have to. If they hit those numbers, it validates the whole acceleration story.
And beyond earnings, it's about putting hardware in space.
Correct. We have confirmed launches of multiple Bluebird units expected before the end of 2025. Every successful launch is a huge technical milestone.
And a driver for the share price.
Absolutely. And management has also hinted that we'll see announcements of new mobile network operator and government contracts before year-end.
Okay, so those are the confirmed items. But in a high-stakes space like this, there's always market chatter. What are the whispers?
There are a few interesting speculative rumors. One is about a potential deepening of the partnership with AT&T.
Deeper how?
We're hearing chatter about integrating the service deeper into AT&T's core offerings for both consumer and enterprise, taking it from a testbed to a core service.
And what about expanding their geographic footprint?
Yes. There are unconfirmed reports of a new strategic investment coming from a major Asian telecom operator.
Which would be a massive coup.
A huge deal. It would expand their global reach overnight. And finally, there's the perennial rumor for any pioneer like this.
M&A potential.
M&A potential, exactly. Market observers suggest that because of their unique technological moat, they could become an irresistible target for a larger satellite company or even a massive global telco.
But we have to stress.
We always stress, these are unconfirmed rumors, they're speculative, and they shouldn't be the basis for an investment decision.
Okay, let's bring it all back to risk. They've solved the funding problem for now, but they're still dealing with incredibly complex engineering. What's the single biggest thing that could derail this?
It all comes down to one thing: execution risk. This is the primary irreducible risk factor.
All the money in the world can't fix a bad launch.
Exactly. The entire investment thesis is built on them maintaining flawless performance, manufacturing Bluebirds at scale, successful launches, integrating complex ground systems, all of it.
The timelines just feel so aggressive. We talked about them spending over $300 million in capex in one quarter. Even with $2 billion in the bank, how quickly could that burn down if they hit a roadblock?
That's the challenge. The $2 billion is a buffer, not an infinite fund. Until that recurring service revenue really scales up in 2026, they are reliant on that cash reserve.
So a delay could be catastrophic.
A major delay, a manufacturing problem, a regulatory stall, any of that could erode the buffer quickly and bring the funding risk right back to the forefront.
And we should also mention customer concentration. That Q3 revenue was heavily reliant on just a few big partners.
That's a great point. You have to factor in customer concentration risk during this ramp-up. If one of those critical partners, like STC or AT&T, decides to slow down adoption, it would immediately impact their velocity.
And their ability to hit that 50 to 75 million guidance.
It puts it in serious jeopardy.
So wrapping this all up, what does this mean for you, the investor, looking at this stock today?
The core message here is one of transformation. SpaceMobile has successfully navigated its most immediate danger, which was the funding crisis. They've secured enough capital to get past that crucial 2026 commercial launch window. That fundamentally de-risks the short-term profile. So the investment horizon is now very attractive for anyone looking to capitalize on near-term technical milestones and the long-term structural growth in the space. The question for you is no longer whether they have the money, it's whether you believe they can translate that enormous cash pile into flawless engineering and execution.